In this video I'm going to list 30 tips for Forex traders. We can divide these tips into 3 main categories: technical analysis, risk management and trading psychology tips. Let's begin with the technical analysis tips first. Tip number 1. There is no such thing as a magic indicator. The vast majority of Forex traders that are starting out in the markets usually look for that one great indicator that will tell the exact moment of buying or selling a currency pair. This magical indicator does not exist, and it will never exist for a few different reasons. However, a good trading strategy that uses the correct combination of indicators, price action analysis and contextual trading is indeed capable of giving very accurate entry and exit points in the market on a consistent basis. Tip number 2. All technical indicators have lag. All technical indicators without any exception have a certain amount of lag that will generate delayed signals. That's a fact, but it's not necessarily a bad thing because there are a few situations where indicator lag can be used to the trader's advantage. Tip number 3. Indicator smoothness and lag are always a trade-off. There is a huge incentive to build a technical indicator that has little to no lag at the same time it has the greatest possible degree of smoothness. Lag and smoothness are two sides of the same coin, so when you increase one, you will automatically increase the other. If you increase indicator smoothness, you will inevitably increase lag. If you decrease indicator smoothness, you will automatically decrease lag simultaneously. Tip number 4. Price action has no lag. Unlike technical indicators, price action has no lag. It's the pure and raw representation of the market and, as you would expect, there is quite a lot of valuable information that can be derived from raw price action. However, just like there is no magic indicator, there are no magic rules about price action either. It's just a tool that needs to be used in context with other good tools. Tip number 5. Trade location is imperative for consistently profitable trading. Trade location is how close a trader can get to the reversal points of the market. Having good trade location means that you will trade near the major or minor peaks of price, which means you will have a small stop-loss order and a potentially large take-profit target. If you trade without good location, you will mess up the good risk management rules and, as a result, you will mess up the trading psychology rules as well. Tip number 6. Contextual trading is the way to go. Contextual trading is a way of trading in which, for every trading opportunity, the trader can tell a story or build a context with internally consistent logic about why he is taking the trade. This can only be achieved when the trader uses the correct trading principles, technical indicators, rules, and guidelines in a specific way. Once again, it's not about what technique or setup the trader uses. It's about how and why he uses such techniques at specific times in the market. Tip number 7. Multi-timeframe analysis is a powerful concept. One of the greatest advantages of trading with price charts is the ability to access the same market using different timeframes. That represents a great opportunity to find high-quality trades because sometimes one timeframe tells you what the others will do in advance. Tip number 8. The most used techniques and indicators are not necessarily the best choice because they are too shallow. The most common indicators that come to mind are just not deep enough to trade successfully. However, when you combine these indicators with other concepts like fractal analysis, chaos theory and other trading principles, they can open certain doors that were not even considered in the first place. Tip number 9. All markets are manipulated at certain times by whale traders. There are certain times in the market where whale traders can manipulate price using the legitimate mechanism of supply and demand in combination with reverse psychology techniques like stop hunting and liquidity bursts. To avoid that or to take advantage of it, the trader needs to place stop losses in the correct places, which is something that unfortunately most traders don't know how to do. Tip number 10. The market has hidden frequencies that can forecast with great accuracy the future minor and major price reversals. This is something that can be achieved by reading the subtle nuances of price action that most traders simply ignore. As it was stated before, price action reading has many hidden gems that can give traders an edge over time. High-quality technical analysis is a vast subject and it's incredibly rich once you understand the framework on which is built. Tip number 11. Certain lines can act as a magnet for price. There are certain lines that can be drawn using price action reading that display a unique relationship with price. It's the next step of support-resistance study. Price will behave in a very peculiar way around such lines, so when a trader can draw them, he will have an edge over the traders who can't see these lines at all. Tip number 12. Support and resistance lines are the tip of the iceberg. Pretty much all traders agree that support and resistance is a well-established concept. However, most of its potential is not explored by traders. There are many ways in which support and resistance can appear in price charts, and if you combine it with other advanced techniques, you can pinpoint incredibly precise entry and exit points in the market. Tip number 13. Candlestick patterns are great, but they're not the full picture. Candlestick patterns are a good way of memorizing certain patterns that happen in the market, but they have a shallow interpretation most of the time. Traders need to go beyond simple pattern names like that to fully unlock the potential of price action reading along with contextual trading. Tip number 14. Price patterns reflect good price action. Price patterns, like candlestick patterns, are easy to memorize. However, that comes at a cost. You can identify these price patterns easily, but they can be out of context, which is something that can end badly. It's counterproductive to memorize patterns without knowing what they mean in practical terms. Once you understand where these patterns come from, you get access to truly powerful knowledge about price action. Tip number 15. Price shrinks and expands endlessly. Price action shrinks and accumulates energy, and then it expands, liberating the energy it accumulated. There are many specific ways of measuring this process. This is one of the keys of successful technical analysis. It is possible to measure the geometry of how price shrinks and expands, and only a small amount of traders understands how to do this effectively. Tip number 16. Price is a bidimensional representation of a multidimensional reality. That's the main reason single indicators don't work by themselves. A price chart has one space dimension and one temporal dimension. The job of a trader is to identify the multidimensional reality that lurks behind these two from time to time. Again, there is a specific way and specific techniques that are used to do that in the correct way. Let's move on now to the risk management tips. Tip number 17. Risk-reward ratios are paramount. It's impossible to trade effectively in the long term without understanding the importance of risk-reward ratios and the peculiarities they have. The main backbone of the risk-reward principle is that a trader needs to expect to earn more than what he risks. This needs to occur in the short term as well as in the long term for consistently profitable trading to become a reality. Tip number 18. There is a sweet spot in risk-reward ratios. Due to the interesting mathematical nature on which risk-reward ratios dwell, there is a specific range of ideal risk-reward ratio values that give the trader a slight statistical edge over time. That idea is not nearly as popular as the idea of risk-reward ratios, but it should certainly be. Tip number 19. Risk can shrink and expand to level the playing field. The Forex markets and its incredibly flexible leverage give an advantage to traders who know how to use it wisely. A trader can contract and expand the risk of each trade to maintain his equity growth within a certain optimal operational range. Tip number 20. Solid risk management reduces psychological pressure. The way traders deal with various aspects of risk is what determines their psychological comfort while trading. There are specific rules and guidelines that help traders mitigate risk aversion and risk-seeking behavior, like techniques called risk collapse and rolling stops forward. Tip number 21. Hyper-profitability is dangerous, but it is possible with great skill. What brings people to the Forex markets is the amazing profitability potential. That's something that can be achieved, but it requires great skill. The higher the return, the greater the risk. There is no way around that rule. However, a trader can significantly increase his chances of success and can also increase his accuracy if he uses the correct tools to trade in the Forex markets. Tip number 22. Never trade without a logically placed stop loss and take profit orders. Almost all traders agree that stop losses should be used for safety reasons. However, the place you put your stop losses can make or break you. There is a huge difference between using a stop loss and using a logically placed stop loss order. To understand this logic that is being referred to, a trader needs to grasp certain details about how price action behaves and how large traders can manipulate the markets in certain levels. Tip number 23. Avoid hyperbolic discounting at all costs. Hyperbolic discounting is the tendency to prefer shorter and smaller returns to longer and later returns. In other words, when a trade goes into profitable territory, the immediate impulse is to close it for an instant gratification. If a trader does this, he is basically shooting himself in the foot because this sort of behavior kills the operational quality of any trade. The trader needs to have the discipline to resist this natural impulse if he wants to see good results in the long term. Hyperbolic discounting also goes completely against the correct mathematical and statistical framework on which solid risk management works. Let's move on now to the trading psychology tips. Tip number 24. Understand the framing problem. Traders can avoid or seek risk depending on how they frame their trading ideas. That's a very subtle issue, but it affects all traders in one way or another. It's interesting to notice that two opposite behaviors like risk-seeking and risk aversion can be triggered by the exact same question depending on how it is asked. That has a major impact in the decision-making process in any financial market. Tip number 25. Math and statistics are not native software in the human brain. To trade effectively, traders need to understand a few mathematical and statistical realities that are counterintuitive to us. That happens because we evolved over thousands of years for purposes that didn't include forex trading. However, by the simple recognition of these mathematical and statistical realities, traders can tune their brains to walk in the correct lane. Tip number 26. Be aware of your risk appetite. Traders differ in many ways. Some have a greater risk appetite than others and feel comfortable risking more. That's an individual and subjective characteristic that needs to be respected. A trader that is not aware of his own limits regarding this aspect can put his trading strategy at risk by putting himself in an emotional roller coaster that he cannot handle over time. Tip number 27. Follow pre-established rules. That's almost a cliché, but it has good theoretical foundations. If you decide to wing it in real time while trading without having any rules, you're going to mess things up very easily for different reasons. One of these reasons is that our cognitive biases produce a negative cascading effect when they don't have any sort of pre-established direction. Another reason is that when we improvise our decision-making process, we are letting the more primitive part of the brain take over on decisions it's not capable of making rationally. The result can be disastrous. Tip number 28. Cognitive biases precede personality. Personality varies from trader to trader, but cognitive biases don't. They precede personality because they were the framework by which our brains evolved during thousands of years. That means that you will face the same challenges every trader needs to face regardless of your personality or how smart you become as a trader. Tip number 29. Psychological pitfalls are silent killers. Most psychological pitfalls of trading occur without traders even noticing them because these traders enter the market without proper education on these topics. The success of a trader is tangled up on three major pillars, which are technical analysis, risk management, and trading psychology. These different spheres talk to each other and are deeply connected. Tip number 30. The rule of the tripod. Just like a tripod falls to the floor if any of its legs is removed, a trader will fail if he disrespects any of the three main trading pillars. That's the golden rule of trading. Technical analysis, risk management, and trading psychology must go hand in hand like a well-oiled machine to produce consistent results. That's it for this video. I hope you learned something useful with it. If you want to learn more about professional trading, don't forget to subscribe to this channel and to check out our professional forex trading strategies in our strategy store. You can also contact us by email at any time. If you enjoy this video and you wish to see more educational videos like these in the future, help support this channel by leaving your feedback in the comments section and hit the like button. Thank you very much for watching, and I hope to see you next time.